After 4 straight days of losses, the market finally found a bit of a spark today.
More than a spark. It was a full-blown relief rally, a really decisive reversal, especially for growth assets.
I mean, the Nasdaq Composite surged 1.38%. That's a huge move.
A huge move. It closed at $23,006.36. And the S&P 500 wasn't too far behind. It advanced 0.79% to finish at $6,774.76.
And it all came down to a sudden collapse in, well, in fear, really.
Precisely. That inflation number hit the wires, and volatility expectations just evaporated. The VIX collapsed 4.26% to 16.87.
Wow.
That's the sharpest single-day drop we've seen in a while. It just tells you that traders were scrambling to cover their shorts.
And of course, the bond market followed right along.
It did. Treasury yields fell pretty uniformly. The benchmark 10-year Treasury yield, it declined 3 basis points to 4.120%.
And lower yields are basically rocket fuel for those big tech names.
Exactly. But here's the tension for today. You had technology soar, up 1.54%, but energy got hammered, down 1.45%. So the big question is, was this bounce a new trend or just a knee-jerk reaction to some, frankly, flawed data?
That is the question. And I think that flawed data point is where we have to start this inflation paradox.
Let's do it, because that's where all the uncertainty is right now.
Okay, so what was the headline number that got everyone so excited?
So the November CPI came in at a surprisingly cool 2.7% annualized reading.
And that's what unleashed the buying.
That's what did it. The rush into equities, especially those long-duration growth names. But, and this is a big but, we have to talk about the huge caveat that comes with that 2.7% number.
Right, the missing month, the data black hole.
Exactly. The October CPI was completely canceled because of the 43-day government shutdown.
Which means they had no baseline.
No baseline data collection for over 6 weeks. So when they calculated this November figure, they were essentially guessing. They had to extrapolate, use incomplete models. It's not a clean number.
And Fed Chair Powell basically said as much. He warned that the figures needed, and I think I'm quoting him here, a skeptical eye.
He did. Some economists said you should take it with the entire salt shaker. And this isn't just an academic problem. It has real policy implications.
Because the Fed just cut rates.
Right. Their December 10th cut of 25 basis points, that brought the target range down to 3.50%, 3.75%. They made that decision with, incomplete information.
So they were flying blind. In a way?
A little bit.
Huh.
And that makes the December CPI, which we'll get before the January meeting, the single most important data point on the calendar.
Because that will be the first reliable number.
The first one collected under normal conditions. So you need to understand that if that December number looks very different from this flawed 2.7% reading, today's rally could look, well, very premature.
Which brings us to the technicals. Did today's big move actually fix the damage from the last 4 sessions?
Well, for the S&P 500, it was a pretty good technical win. It managed to reclaim its 50-day moving average, which is sitting at $6,765.62.
And that's a key level for sentiment.
It is. But even with the big gain, the index is still 2.10% below its 52-week high of $6,920.34. So yeah, we're back to baseline, but we're not at escape velocity yet.
And the Nasdaq, which led the charge, actually looks weaker on the chart.
It does, and that tells you a lot about how narrow this rally was. Even with that huge 1.38% jump, the Nasdaq is still 0.49% below its 50-day moving average.
So it failed to clear that key hurdle.
It failed to clear it. That level is $23,120.57, and it's sitting 4.22% below its 52-week peak. It really suggests this was driven by a few high-conviction names, not a broad rotation back into tech.
Which we saw in that huge sector divergence. Technology up 1.54%, energy down 1.45%. What was the specific catalyst that let tech ignore everything else?
It was one company, Micron Technology. Their earnings after the bell yesterday gave the whole semiconductor and AI theme the validation it was looking for.
Okay, let's get into those numbers. The after-hours reaction was pretty aggressive.
It was a shot in the arm for the whole sector. Micron surged, about 16% after the release? They beat estimates by 84 cents a share on revenue of $13.6 billion.
Right.
But the guidance was the real story.
It always is. What did they project?
Incredibly aggressive guidance for Q2. They're projecting earnings that could hit $8.42 per share on $18.7 billion in sales.
Wow.
It's a massive signal that the AI infrastructure spending cycle is accelerating beyond anyone's expectations. And that story, right now, is powerful enough to make people ignore the questions about the inflation data.
So that explains the big cap tech surge. But if you look just outside of that one theme, you see some really contradictory signals.
You're right. The enthusiasm is very selective. The first place you see that is with small caps.
Yeah, that's a real puzzle. If rates are falling, small caps should love that. They should have had a great day.
You'd think so. They're very rate sensitive. But the Russell 2000 gained just 0.62%.
So it underperformed the S&P 500.
By 17 basis points. That's a clear miss on the day's theme. It tells you that there's still a preference for quality for companies with strong balance sheets.
So big money isn't ready to jump into the speculative end of the pool yet.
Not yet. And you see the exact same story playing out in the credit markets.
Okay, let's look at credit. This shows a similar story, right? A flight to safety even inside of risk assets.
Absolutely. So investment-grade credit, that's LQD, it gained a solid 0.38% to $110.85.
Right.
That's the safer stuff. But then you look at high yield or junk bonds.
It's a split decision there.
A total split. HYG, which is one tracker, was up 0.27%, but J&K, which tracks the really risky lower quality junk jet, actually declined 0.23%.
So investors are drawing a line. They'll take on some corporate risk, but not the riskiest stuff.
That's the definition of selective risk-taking. The daily performance differential between high yield and investment grade was negative 0.11%. In plain English, institutional money is still very nervous about the truly speculative end of the credit market.
And maybe the biggest contradiction of all was in real estate. REITs.
This is a huge one. Real estate should have been celebrating today's drop in yields.
But they sold off.
They did. The main REIT ETF, V&Q, it declined 0.53%, even as the 10-year yield fell to 4.120%.
Why? I mean, lower rates should be great for real estate valuations.
In theory.
Yeah.
But the problem is that a 4.12% 10-year yield is still a massive valuation challenge. For a lot of these REITs, their dividend yield is now competing with a risk-free treasury. The market is saying that a small daily drop in yields doesn't fix that fundamental structural problem.
Okay, so a very mixed picture. Let's widen the lens a bit. What are we seeing in global flows and other asset classes like crypto?
Well, the currency market is interesting. The U.S. dollar index, the DXY, was basically flat. It was at 98.44, up just 0.07%.
Which is strange. If the market thinks the Fed is easing, the dollar should be weakening.
It should be. Its resilience suggests traders are maybe positioning for something else, a big international catalyst.
And we know what that is, the Bank of Japan decision on Friday.
Exactly. This is huge for global capital flows. The market is pricing in something like a 70% to 80% chance of a 25 basis point hike from the BOJ, which would take their rate to 0.75%.
And we saw that positioning in the yen today.
We did. The USD-JPY pair moved up 0.51% to 155.57. A BOJ hike could strengthen the yen, and that could cause a lot of those global carry trades to unwind, which could pull liquidity out of risk assets everywhere.
And speaking of assets that are not participating in this rally, crypto.
A complete decoupling. Bitcoin is in its fourth straight week of weakness. It's trading at $85,426.
And how far is that from the all-time high?
It's 32.42% below its all-time high of $126,080. This is all happening while tech stocks are surging and yields are falling.
So whatever is weighing on crypto is completely independent of the macro story right now.
Totally independent. Whether it's regulatory fears or just a lack of new capital, it's its own story. The sentiment there is terrible. The crypto fear and greed index is way down at 22, deep in fear territory.
So, let's sum it all up. We have a rally driven by Micron, built on some very shaky inflation data, with weakness everywhere else.
That's a perfect summary. A dramatic day, but one that raised more questions than it answered.
So what does that mean for tomorrow? Let's give our listeners some key technical levels to watch.
Okay. For the S&P 500, reclaiming that 50-day average was good, but now resistance is right at today's intraday high of $6,816.13. If it can clear that, the bulls have a stronger case.
But the real test is the Nasdaq, given its relative weakness today.
Absolutely. The Nasdaq must reclaim its 50-day moving average, which is at $23,120.57. That's the line in the sand. If it can't, this just looks like short covering.
And if it does?
Then the next target is, of course, the 52-week high of $24,019.99.
So I guess the final thought we leave you with is that today felt powerful, but it wasn't a resolution.
Not at all. We're in a transitional market where these sharp catalyst-driven moves dominate, but they aren't setting a durable trend. And you can see that in the volatility markets.
Right, the VIX term structure.
It's still in contango. The VIG-X3M minus the VIX is 2.72 points.
And for our listeners, that just means that while things are calm today, traders are pricing in more volatility later. They are not convinced the risk is gone.
Exactly. The big question remains, What happens when we get the first clean, reliable inflation data for December? That's what will drive the next real trend, not just today's celebratory bounce.
All right, I think that covers all the key action and all the contradictions from today. A really busy session with a lot of confusing signals for you to navigate.
It certainly was.
That's the daily consolidation for today. And as always, remember, this discussion is for informational purposes only. It's not financial advice, so please do your own research before making any decisions. But if you found this analysis helpful, do hit that subscribe button and join us. We're here every trading day after the close.
We'll see you next time.